Most people buy stocks the wrong way. What if you can get paid while waiting for the price you actually want? Warren Buffett used this strategy to collect billions in premiums. In this 4-part series, I'll show you the exact strategy that costed me $5,000 to learn, all for free. Traders, welcome back to another lesson. If you're new here, my name is Calvin. I'm an options and futures trader based in Canada. In this channel, I teach you how to generate consistent trading income. Today's lesson will be about how to sell put options for income. This will be a 4-part series, and in part 1, today we will talk about why this strategy is so powerful. We're also going to be talking about the option basics of the strategy, and also we're going to go over how to sell put options, and I'm going to go through some live examples at the end. So why should we use this powerful strategy? This is a repeatable strategy that we can use over and over again in all markets. You can use this on any asset class that has an option chain to it. This beautiful strategy, when you do it, you collect immediate premium income. So when you sell a put, the cash is deposited into your brokerage account immediately, and you can do whatever you want with it. You can use it to trade again, or you can use it to cash out and use it as like your dividends to pay your bills, whatever you want. Another way to use the strategy is you can use it to buy a stock at a discounted price. So for example, if you see the price of a stock is at 100 right now, but you want to buy it at $80, then you can use this strategy to buy it at $80 plus collect the premium on top of that to make your dollar cost average even lower than $80. This strategy allows you to earn passive income through Theta Decay. We're going to talk about that in a later series. This strategy also has a big buffer for error. It is much easier than just going long a stock, because with this strategy, you can be wrong about your direction. It can actually even go down a little bit and you can still collect your full premium at expiration. That's why it is a very high probability, high win rate strategy. And it's very easy. This is not a secret strategy. Even Warren Buffett uses it. In 2007, in his shareholder letter, he mentions that he collected $4.5 billion in premiums using this exact strategy on the indexes. So this strategy is feasible for small accounts all the way up to big sharks like Warren Buffett in the billion-dollar ranges. So it's a very versatile and scalable strategy that's worth studying for the small fish and the big whales. Before we begin, we need to talk about what are options. This is going to be a very brief slide. This may be a little bit quick for beginners, but if you want more details and if you're a true beginner, I recommend you go checking out optionsalpha.com. They have hours and hours of basic option education. My channel is tailored to maybe beginners, maybe at the 3 months mark, all the way up to advanced traders. So let's go through this quickly. Option contracts are financial contracts that grants the right, but not the obligation, to buy or sell at a predetermined price strike for a fee. So it's not free, okay? You have to pay a fee. People buy options to long or short an underlying with leverage. Okay? So again, you get leverage and you can amplify your gains, but it costs premiums to do that. There's a fee. There's no free lunch. So in order to get that leverage, you need to pay. Overall, buying options is a losing game. We don't want to do this. When you hear about options and buying options, you'll hear this a lot on Wall Street Bets, on Reddit, because they view this as lottery tickets. Sometimes you can just spend like a few bucks, a few dollars to make thousands of dollars. That's why it is so attractive to a lot of beginners. But obviously, if you use some common sense, you pay a few dollars to make a few $1,000. There's no free lunch. There's something to it. And the thing to it is you have to pay premiums. And also, the win rate is very low. So to really understand about how to sell put options properly, we need to focus on both sides of the trade. We just talked about the buy side. We need to learn and understand from both sides. We need to learn the buy and sell side of put options. We talked a little bit about buying options in the previous slide, but let me go into more details with this chart. So buying a put option is a financial contract giving the buyer the right, but not the obligation, to sell an underlying at a specific price within a specific time frame for a fee. Okay, so in layman's term, when you want to short a stock or whatever asset class you want, you're bearish on it, you buy a put option to short that stock with leverage. Okay, so in this example, say I believe that the stock will be under 40 when the contract expires. So I would buy the 40 strike, I would pay $200, and then I buy the contract. If on expiry, the stock is below $40 minus $200, so $38, we'll start making money. Okay, so this is a directional play. It's a bearish play. If you're wrong and say the stock is at $50 or anything above this line, this is $38, okay? Anything above $38, you will lose money. So unlike shorting the stock, which has no time restrictions, option contracts have a time expiration that you have to get right too. And there's also fees to it. That's why it's so hard to win. You have to get the time right, you have to get the strike right, the pricing right. And every day you're losing money against Theta Decay too. So this is not what we're doing. So we talked about buying options and how it is an uphill battle. It is not what we want to be doing. What we want to be doing is the other side. We have to sell options because it's a very high win probability strategy. It's a downhill battle. It's much easier to win. Although the rewards will be smaller, the win rate is so high, it justifies it. So this is us. So what's selling a put option? It is giving the seller an upfront premium. We get paid upfront in exchange for the obligation. So this time you have to buy the obligation to buy the underlying asset at the strike price if assigned. The strategy profits if the asset stays above the strike, making it a bullish to neutral strategy. So when we sell put options, it's very important for us to, first of all, we want the stock. We have to be bullish or expect the stock to stay even and go nowhere. It can actually even drop a little bit. It can drop down to a strike price. As long as it's above it at the expiration, you will not get assigned and you will make the full upfront premium. So this is a very, very good strategy. You will get paid right away and the money will be deposited into your account. Now let's go into some examples. This is a live P&L chart from Tasty Trade. This is on SPY. SPY is currently at 660. For this example, we're going to be selling a 620 put. What this means is, as long as in 53 days, you can see there's a 53 here, 53 days to expiry. As long as 53 days from today, SPY is above $620, we will keep the full premium, which is $920. Okay, I repeat, you will keep the full premium as long as we are above 620 on May 15th, which is in 53 days. Okay, now the break-even point, let's talk about it. It's going to be 620 minus the premium collected, which is 920 bucks. So the break-even point will be around 600. It will be around 610 bucks. Okay, so as long as SPY doesn't drop below 610 bucks, you will be making money. Okay, and if on May 15th SPY is above 620, you can see this line right here. From here all the way to infinity, you're gonna make 920 bucks no matter what. You cannot make more than 920 if it remains above 620. Let's look at some live examples. Right now I have SPY opened. The current price is at 655. The slides were prepared yesterday, so it was at 660. But this is a live example. So let's take a look. This is not telling you guys to go open short puts. This is purely an example right now. Right now, it's obviously in a bearish trend. I personally will not be opening anything right now. So do not copy this trade. I repeat, I am not placing this trade. This is for education purposes only. This is how the chart looks like, but let's pretend we want to go long. We believe that SPY will be going up. We'll go to the trade tab, look at the options chain. We're going to look at the options that are expiring 45 to 60 days out. So if we look at here, there's a lot of D's here. These means days. We're going to look for 45 to 60 days. 53 days fall between that range. So let's open that. May 15. We're going to scroll down to 20 delta, which is 605. We're going to talk about the deltas and how to choose a strike in a later video. But for this example, I just want to show you how you would open this trade. You will click on it. Make sure it is red and it says S. S is for sell. And from here, we can see we're going to be collecting 7.7. So that's 770 bucks in 52 days. As long as we stay above 605 in 52 days, we're going to make this full profit. Okay. So it's a very nice trade. You have a big buffer room compared to going long on the stock, because when you long a stock, when you buy at the current price 655, you have 50% chance of winning or losing. But if you buy 605, you're guessing that in 53 days we're going to be above 605. You have a buffer of 50 points on the SPY. If we look at the probability of profit, the POP, P-O-P, it's 83% chance of winning this trade. There's 83% chance of you collecting the full 770 bucks. And we're going to talk about the risk management later, but the profitability of taking profits at 50%, it's even higher. It's around almost 90%. Okay. Now let's take a look at what it means to make 770 bucks. Divide by, say this is cash secured, 605 times 100. There's 1.27% in 53 days. Mind you, the SPY only makes around 10% a year. And not to mention, on average, under 30 days, we'll be closing the trade. So we're talking about 1.27% in less than a month. That's for one position. And we have a very big win rate. So this is a very lucrative strategy. And you can do this on all instruments. Let me show you. You can do this on any ETF that has option chains. So XLV, say you want to play this one. Same thing. You go here, you look at the 20 delta, click on it, make sure you're selling, and you will be collecting 1.47, which is almost 150 bucks. straight into your pocket when you open this. So that's it for now. So watch out for the second part of this series. In that series, we're going to be talking about how to choose a good stock, how to choose a good strike, and also the time expiration. We're going to go into more details. It's going to be more hands-on and more live examples. I hope you enjoyed this. If you have any questions, post them in the comments, and I'll try my best to answer them as soon as possible. Please like and subscribe. Trade small, trade safe.